Federal discount rate. The federal discount rate is the interest rate set by the Federal Reserve (Fed) on loans extended by the central bank to commercial banks or other depository institutions. Adjusting the discount rate allows central banks such as the Fed to reduce liquidity problems and the pressures of reserve requirement, control the supply of money in the economy, and basically assure stability in the financial markets. How the federal discount rate works. In addition to its other monetary policy and regulatory tools, the Fed banks can lend directly to member banks and depository institutions. This is part of the primary purpose of the Fed as a lender of last resort to ensure the stability of the banks and the financial system in general. To prevent undue bank failures, healthy banks are allowed to borrow all they want at very short maturities from the Fed's discount window, and it is therefore referred to as a standing lending facility. Under normal circumstances, banks prefer to borrow from one another on the overnight lending market. However, banks that face increased liquidity needs or heightened risk are sometimes unable to raise the necessary funds in the open market. Once the interbank overnight lending system has been maxed out, FED's discount lending serves as an emergency backstop to provide liquidity to such banks in order to prevent them from failing. Borrowing from the central bank is a substitute for borrowing from other commercial banks, and so it is seen as a last resort measure. The interbank rate, called the Fed funds rate, is usually lower than the discount rate. As long as the Fed funds rate is lower than the discount rate, commercial banks will prefer to borrow from another commercial bank rather than the Fed. As a result, in most circumstances, the total amount of discount lending is very small and intended only to be a backup source of liquidity for sound banks. 3. Discount rates. Discount lending is generally classified as either primary or secondary credit. The Fed also set a seasonal discount rate for non-emergency lending to banks that serve agricultural and other communities where credit demand is highly seasonal. Depository institutions and commercial banks that are in generally sound financial condition are eligible to borrow from their regional Fed banks at primary credit rate. This rate is commonly just referred to as the discount rate. Funds for commercial banks borrowed from the Fed are processed through the discount window, and the rate is reviewed every 14 days. The federal discount rate is one of the most important indicators in the economy, as most other interest rates move up and down with it. Secondary credit is given to banks that are in financial trouble and are experiencing severe liquidity problems. The central bank's interest rate on secondary credit is usually set at 50 basis points above the discount rate. The interest rate on this loan is set at a higher penalty rate to reflect the less sound condition of these borrowers. The discount rate and monetary policy. Beyond its role in preventing bank failures, the federal discount rate is used as a tool to either stimulate or rein in the economy. A decrease in the discount rate makes it cheaper for commercial banks to borrow money, which results in an increase in available credit and lending activity throughout the economy. Conversely, a raised discount rate makes it more expensive for banks to borrow and thereby diminish the money supply while retracting investment activity. Besides setting the discount rate, the Fed has several other monetary policy tools at its disposal. It can influence the money supply, credit, and interest rate through open market operation in U.S. Treasury market and by raising or lowering reserve requirement for private banks. The reserve requirement is the portion of a bank deposit that it must hold in cash form, either within its own vault or on deposit at its regional Fed bank. The higher the reserve requirements are, the fewer room banks have to leverage their liabilities or deposit. Federal discount rate versus federal funds rate. The federal discount rate is the interest rate the Fed charges on loans. It is not to be confused with the federal funds rate, which is the rate banks charge each other for loans that are used to hit reserve requirement. The discount rate is determined by the Fed's Board of Governors, as opposed to the federal funds rate, which is set by the market between member banks. Thank you.